Good evening. Ira Epstein with your financial market wrap-up. And this wrap-up is for Wednesday, the 15th of April 2020, tax day, but it's not really because they gave us another extension. And we're at about 4:40 p.m., and that is Central Time. A stock market down day, not to be unexpected. We had a lot of economic data from the New York Fed numbers coming out. It was just report after report, and they were all terrible. And as a group, that's what you'd expect. We're starting to see the full impact of the COVID-19 on the economy. And what you don't want to see are the numbers trickle in. You want to get to bad numbers because from bad will come good when we can start getting back to whatever the new normal is. And there will be a new normal. It's not going to be the way that it was. It's going to be something different, and they're going to evolve into what that something is. But in the meantime, the shock to the market is, oh my God, it's really as bad as everybody thought. Remember, you have another wave of employment claims coming this week. Take a look at energies. Not up, down. They can pull the plug on everything they want. They're unable to do much with it. The grain market down across the board as well. The dollar was up today, but it's one of the few areas that were up other than when you look at the bonds, the notes, and the coffee market. Most markets were down. So when we take a look at what we've got on a weekly area chart of closes, we haven't gone anywhere this week. We're middle of the week, we're down 4.65 points. It feels worse because the volatility every day is hundreds of points in the Dow and obviously a real lot in the S&P. You'll see as we get here. Where's the market stalling? At the 50% number. This is your 50% line right here. And that's where the market's stalling. Now, yesterday I made a statement, and I'll stick with it. I would be concerned that you're not going to get down to these areas again if you get over this 62% retracement. Even getting up there bothers me. Being at the 50 level, you can still make a run to the downside. How deep a run? I can't answer that. I don't know if you're going back to those lows. I know we're entering a worldwide recession. We're entering a period where you just keep spending money. The $350 billion for small businesses, that money's spent already, guys. They're still getting applications in. They've got to go with another level of it. So we're not dealing with $1 trillion here, $1 trillion there. We're dealing with lots of trillions coming out just in America. And where else is it going to happen? But the harder they try, the better it comes back. And that is the thing you have to watch. Because eventually getting any sales in a store is better than no sales. That's the point. When we take a look at what the market's at, you've got a pattern of higher lows, higher highs. This is the correction. We've come up to that 50% level. Now the market's stalling right here. If it continues on, you go up possibly back to the 3,000 level. And at that number, if you get there, people are going to say not only is the worst behind the market's way ahead of it. I don't know. I think that this is the zone where the danger lies, right here, this 50% level. I look at the market and I can see that it got up to the upper Bollinger Bands. It's backing off a little, but it's still very much in an uptrend. And you can see you still have an embedded reading. When I look at a chart, the dominant factor on a chart is if you have an embedded reading. Embedded means that the oscillators that make up the slow stochastic have locked in over 80, and it means until they come out of that, and it'll be the K line, the red line, that comes out first. Until it comes out, the trade is a buyer in this market on breaks, including days like today. When you look at the NASDAQ has the embedded reading. It went up, and the resistance it decided for the moment at least to pay attention to is the combination of the 100-day moving average of closes in the upper Bollinger Band. Prior to this, the market was paying attention to the Bollinger Band and the 200-day average. So what it did is the marketplace, for whatever reason, we know that it was the FANG stocks, that's the reason, they took off again to the upside, and you move to another level. And that's where the market seems to have stalled right now. This still rules the day, and until it's lost, I contend breaks in the market get well supported. In the Dow, you have the embedded reading as well. Now, you have an outside day down in the Dow. An idea that the market wants to go higher would be taking out today's high. Why? One of my rules that I look at on charts is if you take out the high of an outside day down, especially a key reversal day, the day after it's made or the day after that. So in plain English, Thursday or Friday. If that's taken out, the next target is wherever they keep another moving average above the market or the closest of a Bollinger Band. Bingo, it's the Bollinger Band. So that's the number I'd be looking at there. But right now, still in the friendly camp. The market that we know has been the weakest, it's been consistent, has been the Russell. So this index rolled back down. Didn't do much of anything. It tried to get where? If we take a look, both numbers over 80 yesterday, not the day before. So you just didn't do anything. You got overbought, and that was the end of that. In the cash VIX, I made a statement that when this market got down to 37.31, you're no longer at 85. You've come in here a dramatic amount. You've really pulled back. This market is almost making a statement, and it's saying by keeping the embedded reading that the pullback in stocks, yeah, I have the right analysis on it, that's where it's at. Now, what I do expect to happen is if this market were to break down, I think the pros would write puts at 33.65, looking to see if the market makes a run back to the 50 level, 52. So we'll see what happens. Right now, the bears are in control of this market, which is still friendly to the stock market. In the June T-bonds, we're just playing at this 18-day average of closes. You're not going anywhere, and as this sideways actions happen, take a look at what's happening in Bollinger Bands. They'll wrap their arms around, and then they'll go sideways like that. These numbers, because volatility has come out of the market. And yeah, that's what I'm going to tell you. This is not, if you look at these swings, you're not doing that anymore. You've gotten much more normal. In this, the Fed has tamed down parts of the curve yield, done a real good job of it. Now today, the 10-year note decided to stick its head up, but that's not a surprise to us. This is what we looked like yesterday, higher lows, higher highs. If you clear this number, 138, maybe you make a run up there. You still have divergence as momentum was pointing down, but momentum stepped up today. This kicked it back. This market runs, no reason why it shouldn't pay attention to the 139.16 resistance level. Support way back at the 18-day average. You take out the pizzazz to the upside if you take out 137.27. In the dollar index, we're getting a rally as the market got too oversold. This is what we looked like yesterday, and we had mentioned that. And now the market's getting a bounce. That's all it is. So far, it's a bounce. You're still in oversold territory. We'll see what the market does if it can get up to that 18-day average. You break the downtrend if you clear 151. Next, the eurocurrency. Outside day down, but really what this market's doing is setting up a trading range in the neighborhood of this 18-day average. And you've got all kinds of factors here. You've got flat momentum. You've got a market with upside bias. The trend is up, but it doesn't seem to want to lift beyond this level. If it did, the resistance would be the 100-day average at 111.77. 111.17 and a half, and 111.55 and a half. So we'll see where that goes. You know, I'm supposed to get the other eye done. I had one eye done. It's the weirdest thing when you see out of one eye good and one eye not so good. When I come to the Japanese yen, outside day down. So if we take a look, today's high was 93.68. This high was 93.78. We're back into a pattern of lower highs. We've had lower lows. It puts the support zone back here at 92.51 to 92.20 back into play. If the market clears today's high, very important, it's an outside day down, then I look for the market to get up to the 94.51 level, especially if it's done on Thursday or Friday. Today is Wednesday, so that's how I'm looking at that one. In the June Bitcoin, you've gone flat against the 100-day average. Now remember, it's April 15th. In early May, I think it was May 11th, I forgot the exact day, where the halving takes place. And it means the computers that generate these Bitcoins, what do? For the same thing they're doing, they only get a half a coin. the algorithm changes again, and that's the theory behind this. There's fewer and fewer coins after the first rounds of them are produced, and that in theory is supposed to keep supply demand more on the demand side for fewer coins that could be mint going forward. The differential between the Brent and WTI, it's all the way back to $1.65. So we saw a market that got down to $1, rallied up, went through the 18-day average, right back under it, and has fallen apart. So the market is not giving a very good grade so far to the OPEC deal. In terms of Brent itself, well, you can see we're caught in a trading range of these bands. Again, you came out of this violent move to the downside, and really, it's hard for me to say it because I know it's hard for you to believe it, because we're down $2 a barrel today. That's a big number, but that's not as volatile as it's been. And you see that with the sideways action in the Bollinger Bands. When we get to the WTI, you're seeing the same thing. Neither are trending. You have higher highs, lower lows, no follow through so far. Gasoline has done its best to try to get up and through the upper Bollinger Band. Doesn't seem to be able to do it. In fact, if it gets back under here, and you got to watch it, 71.50, it could have a lot of problems back to the downside. And in the nat gas, vertical move up, vertical move down. Too difficult, way too difficult. There are times you look at markets and say, they're just too difficult, I think I'll walk away. Now, for a lot of you that watch this, I know you trade the spiders, the ETFs. And what I've done is I decided, month and a half, 2 months ago, to begin my recordings of them. Now, they typically come out around 4:30 in the afternoon. They're already posted today. And what I try to do is the same I do in futures. I want to give you that confidence that you already have, but maybe, just maybe, you're looking for somebody else to say, this is what I'm seeing too. And you go, yeah, I like that. That's exactly what I was thinking. Or no, he's got a point. Why am I this way in the market when the chart's looking this way? I cover this in technical analysis, 27 charts, the large ETF spiders, the most popular ones. Can I do others? Yeah, but we're going to have some, if you will, webinars, that's the right word for them, that'll cover that. But these are the ones that I cover. And by the way, when I have the webinars, you're invited to ask questions and so on. I'm waiting for a new camera. And you know what, today, waiting for a new camera is not the easiest thing. Everything on the internet's bought out. But if you'd like to get this and take a look, let's face it, $8.95 to look at videos for 30 days, that's pretty darn inexpensive. After that, it's $16 every 30 days, and there's no contract. You decide if you want to do that. How do you get this? You don't need to even talk to us. Go to our website, under the word research, go to market research, you'll drop down menu, you'll see the Spider ETF video, click on it, explains everything, and away you go. I'm Ira Epstein. Thanks for watching, and I'll see you all tomorrow.